Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday. Nope, it's Wednesday. Wednesday, October 2nd, 2024. It's 10:10 a.m. Eastern Time. I'm starting the video, and here's what we're going to do in this one. We're going to take a look at a quick update on just the broad-based commodity ETFs. I won't do one. I've done some all-inclusive that cover all commodities, metals, and industrial metals, precious metals, agricultural commodities, etc., crude oil, natural gas. Those were all done in the last week or so. But what I'm going to do here is just take a look at the broad-based ones, commodity ETFs, then focus on primarily the trade ideas in the agricultural commodity arena. So we're going to look at ag commodities. We have some of those have been trade ideas for a while. Primarily the grains have been my favorite. And then the ag input stocks I made mention today, and we'd hit the second target. It had me take a look at the agriculture input stocks. So I've been doing this for a long time, and what I've noticed is when they finally start to catch a bid. Remember, I've been highlighting bullish developments on the grains for a while, and we've been putting in these divergent lows, and we've had some good swing trades hitting 60-minute chart targets. But once they start to run, and in the case, again, I've been making on the long-term charts for the next leg up in a bull market in commodities, especially the ag commodities. If that is the case, particularly with the grains, it's been my experience that that's when the ag input stocks run. Those are companies that make things like fertilizers, et cetera. So, and they tend to go up with the grain. So, anywho, one of the best looking sectors. Some of these stocks even look like they're about ready to let loose right now. So I'm going to go over those trade ideas. And all these were shared just back in June, I think it was, a few months ago. And so they still have the same constructive charts, actually looking a little better now. So let's get into them. DBC, Broad-Based Commodity Tracking ETF. And you have the primary downtrend line right here off the high right there. If you're new to this, new to my analysis, this is a long-term chart. Again, this is a very well-diversified broad-based commodity ETF. And so I've made the case that we had a bear market in commodities. That's not arguable. It's pretty clear. Ended in when COVID bottomed, and the market bottomed in 2020, March of 2020. And by every single metric that I can use, primary downtrend line being taken out, all the higher highs being taken out. This is all the makings of a new uptrend, a new bull market. There are no guarantees with any of this, but that's the look of the charts here. So this bigger picture, and I've maintained for a while now, this is a corrective wave. So we were able to milk up the bulk of that. Turned around, the charts were glaringly bearish at the time, looking for a correction, way overbought, negative divergences, at resistance, all that other good stuff. And I think we've come full circle. This is a positive, aka bullish divergence, especially right here on this most recent low. We had a little wedge breakout there. And anyway, so that's kind of bigger picture. There's that downtrend line I had for you on the daily. And so this is looking good. Whether it's a swing trade or a position trade, longer term trend trade. Divergent low here, I've highlighted these last couple divergent lows, and we've had nice trades. But ultimately, we could start to go on and take out the previous highs and then embark on a new longer term uptrend. So I just want to kind of impress that there's a potential. How to trade it, it's up to you. You can, if you're looking for longer term positions, 401k, IRA type stuff, or even in your regular investing account, the non-IRA, just trade the charts accordingly. Set stops commensurate with your price targets, and I like to set my stops tactically, above or below, a little bit below key pivot points where pullbacks are likely to be bought up. But let me get to the rest of them real quick. So that's the bottom line is we take out that downtrend line. It's not super well defined, guys. I will say that we had a downtrend line here. It was kind of, remember, the problem with this is that it has so many different commodities that some of them have absolutely nothing to do with the others, no correlation in their charts. Again, it's broad-based, so you get a kind of little bit of a sloppyish chart there. You've got gas, WTI crude, Brent crude, New York Harbor, unleaded gas, natural gas, precious metals, gold, silver, and then all your ag commodities, and base metals, copper, aluminum, zinc. So again, it's a good one-size-fits-all. And let me get to the rest here. I'm going to go to DJP. DJP, this one I've used also for years as a kind of a guide to see where inflation's likely to come in. It's another broad-based commodity. It's actually an ETN, same thing. You've got diversification among energy, grains, oil seeds, precious metals, industrial metals, soft, and every time we've come down here to this key support, 29, I've highlighted that as objective long entry. We had positive, aka bullish divergence, as we did on this last pullback here, and that was the last time we highlighted it. And so far, so good. The commodities are vastly outperforming the stock market. So, as I often say, the stock market is one thing to trade. And I'll constantly do updates on that. I don't think a day, certainly not a week, won't go by where I don't do updates on the equity markets. But then the key to this is drilling down, finding the most conducive securities to trade, be it a sector, individual stock, a commodity, an index, whatever it is. So there it is. So on the chart here, DJP has had this trading range here for a while. It's been in this sideways trading range. It's been very swing tradable, if you will. One false breakout there that ended with a divergent high. Breakouts that occur with divergence have a much higher rate of failing, as I often say. Another pullback fell into the range, and as we often do, we go to the bottom of the range. And so now we're at the top of the range. One thing I'll say, you might look at it and say, okay, Randy, watch, rinse, repeat, right? Yeah, that's what you do when you recognize a trading range. It's something as a swing trader I love to do, whether it's a sideways range like this or an upward sloping price channel. But all trading ranges ultimately come to an end, and there will be a breakout. And if it's to the downside, anything but a whipsaw, that's going to be clearly bearish and most likely to determine the next trend based on everything I just told you a minute ago, based on a longer-term outlook of commodities, my expectations, an upside break. And sooner or later, you're going to get that. So there comes a point, in other words, where you may want to stop shorting rallies back to the top of the range, and you may want to get ready to position for a breakout above and either sit tight on your positions if you have them or add to or take a new position there. And, of course, it'll help to see that high get taken out. So that's DBA, daily chart there. Now let's go to the individual grains, and then we'll get into the ag input stocks, and that'll give you guys some new trade ideas or updates on the ones I threw out in June if you're still in any of those. Wheat right here. Let's just go to the 60-minute charts. I just gave you an update there today. We've been looking at these divergent lows, this objective entries. So far, this looks to be the one that's stuck. What do I mean by that? Well, we've had this trading range we've been in. And I've been saying all along since we were in it, we needed to break a solid break above T1 would most likely do the trick to get us going. So we broke out, we back tested. As I say with back tests, sometimes you come a little bit within. It's just what the nefarious powers that be, the evil forces in the market will love to just take because everyone looks to buy a pullback to the top of the range. So you got a lot for, or allow for, a little stop raid. They take it back in. Plus now you have a trend line also. I just added that, by the way, to the chart after I got that one out to you today, that 60-minute chart there. Either way, so it's a breakout, effectively a back test, slight undercut, and that's bullish. That's longer-term bullish because this was a basing pattern right here. And we hit T2. We have some divergence, and that could end the rally, could cause a correction. All I can tell you is any pullbacks to this uptrend line, as well as a pullback to the top of the range. Anywhere really you don't want to see it go much deeper. We already cut back into the range once, so really down there around that $5 level right there, I think is a good and maximum level where I think it would be objective to buy pullbacks too, but not below $5. Go below that. There are no guarantees, but it's not going to be good, and we may just be, in this long-term kind of slogging around basing range. And remember too, guys, at the end of the day, what we're talking about here is wheat. We're not talking about some latest AI company, some startup with no earnings, a ton of debt, a lot of hype built into it, and potential, down the road or anytime Chapter 11 bankruptcy, corporate malfeasance like, SMCI. Cooking the books. Some hedge, short seller called them out on it. That's what short sellers do. They tend to sniff out the, just like Enron. Enron would have, who knows how long would have gone. It would have definitely gone on much longer if it wasn't for short seller, a big company, put a short on and then put out a research report just like they did on SMCI, and that opened up the investigation and caused them to delay their quarterly filing. So my point is, where I'm going with that is, it's wheat. It's just like natural gas. I told you we're buying it down towards the low end of its historical range, and there are no guarantees. You can go lower, but the day that you go to zero means they're giving wheat away free. You can go anywhere you want, and wheat is now free. So that's not going to happen. My point is, it's something that if you're looking out longer term and you're buying it towards the low end of the range, you're not going to lose your shirt on it. Then again, with that being said, stops are, a must with any trade. So I'm not saying hold it forever. You could drop 50% and you don't want to drop 50%. It's still not going to go to zero. It could then drop another 50%, still not going to go to zero. All I'm trying to say is at the low end of the range, looks very attractive. And the charts are beautiful. I mean, that's the main thing. This was the last time back here in 2020. And from there, you had the initial bull run in wheat. Was about 170%. Yeah, this was Ukraine really at the end there, the Russian invasion, Ukraine being one of the biggest wheat producers. But all the other commodities, the ag commodities, are still, they have more charts that look more like initial leg up, new bull market, corrective wave with another leg to come up. And this is corn right here. As I mentioned, corn and soybeans are kind of the sister trades to wheat. It's nice to spread it among all of them because you never know which are going to outperform, but they tend to move together because they're competing food sources. Alternative, you can use, can make your tortillas out of corn or wheat, you pick. So the price of corn goes through the roof. What are you going to see in the restaurants? You're going to see more wheat tortillas, right? Simple stuff, right? So they tend to move together, and plus they're also grown in temperate climates together. So they have the same kind of impacts, on with that for the most part. All right, so there's corn. Corn broke out. These were your targets all along. You had the breakout right here, highlighted back then. We hit this first target, danced on it, 1819, broke out, and now we've broken out above 1848. And what I want to point out, look, I don't guarantees, guys, but it's smooth sailing. See my volume and price histogram over here on the left? That's these green and red bars. I'll turn them up so you can see. Given more on a 60-minute chart, but if you look back, what this tells you is there were a lot of buyers in here as it was basing, consolidating. This is an extremely thin zone. A thin zone is very similar to a gap. A gap is an absolute thin zone. You wouldn't have any volume price histogram. There's no trades, but this means very few. It just had a swift drop down, very few trades, and these are the top of your volume price histogram bars. They work great to help align price targets. I always set my price and resistance targets primarily based on resistance and support levels, but I do very much find these volume price histogram bars useful. It just tells you there's a lot of overhead supply up here. I mean, a lot of people were buying because it was in this trading range right here, which could have went either way, but it went this way. So that determined the next tradable trend, which was down once it broke below that trading range. So there's your target right there. 1949 sits a little right about where that volume of price histogram starts to get thick. This price resistance. And so again, it should be, no guarantees, relatively smooth sailing. That doesn't mean it's going to go up every day without any pullbacks. If it does pull back, then the way it works is pull back to 1848, which was a price target, which was resistance. Resistance, once broken, becomes support. That would be an objective entry, as would a pullback to 1819, as would a pullback to the trend line. I don't want to see much more than that. You also have, like wheat, potential uptrend line forming. So this is kind of buy down to here. If you get it, my experience is kind of like natural gas. When these guys start to get a bid, they can get going. So it'd be great if you get that. You may not get that pullback. So just keep that in mind. It may just want to keep running up. Sometimes they'll do that. All right, moving on. And then I want to get to the ag inputs. There's not too many on the ag inputs, so this won't be a super long video. Soybeans, the other one, divergent low right here, and this is up off the divergent low about 11% so far. There's a potential uptrend line. T1 was hit here. T1 was resistance, and he pulled back, and it did. It went up, pulled back, pulled back, pulled back. So this one still has, and again, I'll most likely add additional targets. These are just 60-minute charts. But now let's roll into the ag input stocks. I'm just going to enter one to queue up my list. I have a watch list here. There you can see it, ag input stocks. So we're just going to go over these handful of stocks here. Again, last time I updated these in May. You can go back if I'll tag these. These will be symbol tagged under the post, meaning you could click on those symbol tags to see the previous updates. Alrighty, starting out here, let's go in order by market cap. Some of these guys get really small. These are small and even micro cap companies. But I'm starting out with the biggest one here, CTVA. It's a $41 billion company. So this is a big, large cap, Corteva. What I note here, you do have negative divergence. Again, there is a bid, there's momentum, the sector is bullish, and right now, divergence, as I always say, it's not a sell signal. However, this one's at resistance. You have an uptrend line, which if broken, will likely send it back down. So it's been in this trading range right here after this bullish divergent low and breakout right there. Had a powerful gap up on the breakout. If it can power up through here and especially take out the divergence, meaning we take out the previous highs and we no longer have negative divergence, that would be bullish. I will say it's not my favorite. You tend to get more juice, more bang for your buck on the smaller ones. I'm going to go down, but just wanted to update that one for anyone in it. NTR, I love this one here. Own this one. I've owned them since June. I've held on to these guys. It's just long-term, small starter positions, which I'm probably going to add to today now that wheat has kind of brought them back to my attention. NTR, let's see here. Primary downtrend line comes off the high back there in early 2022. Breakout, backtest, that's backtesting. All the while the divergence is getting bigger and bigger. And it's now, it had this $49 support right here. So I believe back in June when I was covering, I would have mentioned that. And it seems to be the story. They all had this, what I'm viewing as a false breakout bear trap. Like I said, the charts remain constructive. So that's why I give these guys some rope. And I had small starter positions and all. And still do, and I'll start to add to these probably today. I wanted to get the video out to you guys right away. So what I see here, what I spy with my little eyes, a little W bottom basing pattern right there. And you've heard me say this once. If you followed me, you've heard me say it 1,000 times. Fewer things investing and trading are more bullish than a failed breakdown. So this was a very well-defined support level. So I'm sure a lot of what I call JCL or Johnny-come-lately short sellers piled in. You know, who wants to short a stock that's down, sometimes if you think it's going to zero, but the dang thing was down 62% off the highs. It's ag input stock. Again, I don't know their exact business model, what type of fertilizers, if it's even fertilizers they're selling, but very constructive and bullish chart. And now the fact it's taken that level back, that is nothing but bullish right there unless that fails. So that's what you can set a tight stop or give it some room. My targets on these, when these guys run, I've traded them for years. When they want to run, they really run. So if you bought it back in 2020, remember what I just showed you when commodities bottomed? Remember, we were long. You can go back on the site where I was very bullish. Wheat, corn, the same things now. We were long and strong those. And so what happened? This sucker rallied 400%. Right there, lockstep with commodities. When did it peak? I just showed you commodities had that corrective wave. And so what I'm trying to do now, and guys, please, use proper position size management. These are volatile stocks. I like to take a shotgun approach to the best of my knowledge, and I could be wrong, but I don't believe there's an ETF that specifically targets this sector. Maybe there is. I'll look for it. If you find one, please post it in the comment section. I like to take a shotgun approach by sprinkling a little bit onto the most bullish stocks within the sector. Avoid those that don't look as good. And because you never know which one's going to take off. Typically, as I go down this list, I'm doing these in order of market cap. The smaller ones are the ones that you have more risk. You have risk that these small companies, there's a reason some companies are only, I'm going to get down in this list. They're priced at, market cap on one of them. Actually, I own is a $1.4 million market cap. There's probably a lot of people listening to my voice that can buy that entire company right now, write a check and own it because the market cap's only 1.4 trillion. That's YTN. So you got to be careful with those because when you there's a reason companies have such a small market cap. There's a lot of risk. They're probably saddled with debt. uncertain business model, who knows? And so on those, I'm not going to sit here and go over the suggested beta adjusted position size on each one. But what I encourage you to do, if you like these, start out by looking at the market cap, number one, and know that, if you're at a multi-billion-dollar company, there's typically less risk generally. And then you get down to, companies that are below a billion, especially in the hundreds of millions, and then especially less. I even have one on here that's an $850,000 market cap company. I'll get to that at the end. And then those you just take a little bit, your Vegas money. You put, if you usually put whatever your number is. Say you put 10,000 normally in a stock, SPY. Then you might want to only put 1,000 in one of those smaller market cap ones, because the profit potential on them is measured in triple digits if these play out the way I think they do, those smaller ones, that is. This one alone, you want a ballpark target right here. I'd say about $69. That would be 36%. This is right now a sweet spot, a very likely target in the near term, and that's about a 20% run up to 60.44. And then where to stop out if wrong, you can keep a tight stop, not too far below this uptrend line off the lows, or again, relative to what you're targeting. I mean, like I said, if there's a new leg up, these guys could go on and take out that previous high from 2022. Very, very possible. So I'm just showing you some kind of near-term targets. Longer term, again, if this is if we've just entered a corrective wave in an ongoing longer bull market in commodities as a whole, and these guys are going to be the beneficiaries, then yeah, there's plenty of upside. And if not, they don't work out, these divergent lows just fizzle out, we take out the lows, I'll update them again when they look good. And like I said, use your stop. At this point, I think it's safe to say at least a stop, not too far below the recent lows. All right, let me move on to the next one. So you can kind of screenshot this. See, these are all potential price targets right here on this chart. CF, look at that breakout right there. This one put in a divergent low back here. Again, I updated last time in June right here. Like so many, they just right after that, they had this little washout, fake out move, and I view that as super bullish. The fact that you can see it was a very, very well-defined trading range, right? Back then. They took it out. That is a bear trap. Vicious to the shorts, because it went down, they put in a divergent low, so the charts were still constructive, and they were they're actually even more constructive now than they were back in June, because this one regained that level shortly after, and you can see what happened. Short sellers that shorted the breakdown of that well-defined support at 73 got smoked. The stock exploded up 20% right there, safe to say, and so a lot of that was short covering, and now the day is early, but if it can hold this breakout, especially starts to get away from there, very powerful stuff, because that is a very, very well-defined trading range. I mean, a blind man could see that trading range. It's so obvious. So there's a breakout above 87.26. Yeah, I'll give you one little minor resistance target, but right about here, you can get a couple reactions there, 90.77, call it 91, but it's not a whole lot up to about 110, and that would be, this thing could run up there. You're talking about 25% run. Same thing, you can put stops, a little bit below the trend line, a relatively tight stop, or below the bottom of that trading range. We already had one breakout, but it still supports 73 roughly. And then, of course, that previous low, that's where you'd now add. You have a reaction low, you have a couple there, and that's your next support, 69. All right, so looking good. It's breaking out. If that breakout holds or can be built on, so maybe one way to do it too is start scaling in, maybe not an all-in moment. If you want to be careful right now that this isn't a false breakout, take a starter, and then if the stock continues to perform well, add to it. Remember, a big difference between pros and amateur investors, meaning retail crowd. Retail folks generally tend to average down on a stock, believing that they're lowering their cost basis. Again, if that's part of my predetermined plan, I will scale in. Only if it's a predetermined plan that I'm going to buy down to, but not below a certain level when I'm going long a stock. However, the pros, what they tend to do instead of averaging down, because what happens is if a stock is going down after they bought it where they thought it should have gone up, it proves they're wrong. Their analysis is wrong. So therefore, they don't average down and dig themselves into a hole. With that whole I'm lowering my cost basis thing. No, pros tend to add to positions on strength because it shows that they're correct. Their analysis is correct on that stock. So you could do the same thing here. Take a starter and add to it. No, you don't keep adding right there when you're coming up to that beautiful price target right there, about 110.42. Then you start getting ready to, raise stops and or book profits, right? Okay, next up, Mosaic, ready to pop. Beautiful downtrend line right there. Big bullish falling wedge, divergent low, great looking stock. First target there, but I would sit tight. If it pops that downtrend line, it's probably going to run up. I would say right there is my current preferred target, and I may add others right there. I think a likely swing target that's going to be about a 53% rally. That's just shy of $43 right there. I could pull it down for you, but here I'll put a separate line. And we'll just, there's a little gap there as well. So we'll call that 1, 2, 3, 4 T4 zone, fourth target zone, which means, it's likely to reverse anywhere from the bottom to the top. It's a relatively tight range. FMC, we have a basing pattern. We also have what we call an ascending triangle pattern right there, like that. Breakout above that, it's going to be powerful. Look at this pattern here. Divergent low there. Downtrend line is going to be your first target, so we're going to extend that over. Potential downtrend line. It hasn't. We need another confirming reaction, but look to the left here, guys. Big old thin zone right there on the volume price histogram, and that's why my first horizontal price target's almost $87. So that's going to give you about 27% if hit. I'll give you another target now, just in case this party gets going. 97.75, and that's an old level I had from before. So I'm just going to leave it there for now. Yeah, I think it still comes into play. All right, so I like that one also. So far, really pretty much everyone but the first one are my picks, and I believe I have positions and all. And we'll add to, and if I don't, I'll add to the ones that I don't, that I mentioned I like here. ICL Group, beautiful downtrend line. Look at that. Boom, multi-year downtrend line. Big positive divergence has been building, steepening at this most recent low. What I mean by that is you have equal lows in price with higher lows in the indicators to steepen the divergence there, increase the slope of it. And you have price resistance at 438. Set an alert, and this thing's probably going to explode. These all have the potential to explode. And now if the market craps out, remember they are stocks. So even if the commodities continue to run, there's a possibility these face a headwind, especially those that are indexed. That's the thing about indexing. It works great in a rising tide. All ships are lifted. Money is flowing in. Most of these are small enough. They're not going to be in the S&P 500. Maybe that first one, but I don't know offhand. I didn't check. A lot of these smaller ones may be in the smaller microcap indexes or not. I don't know. You can look that up yourself. I just trading these on their own charts, their own technical merits. $5 or $4.95, $5.52, $6.64. That gives us a potential, if that final current target's hit, about 52%. So that seems to be about the common theme. If these guys can hold up and build on these breakouts, SMG, Scott's Miracle Grow, most of you are probably familiar with that. If you're a homeowner and you have a yard, you go to Home Depot, you'll see that's their big fertilizer for both residential and maybe, I don't know if in commercial or industrial or not. But either way, this is a big level. It's about a little over $86. You can see it was resist. It was support. We broke it. Back tested, rejected. Back tested, rejected. We're there now. If we pop it, going to be a nice one. So I'm liking this one as well. There's an uptrend line also in case things don't work out, like any trade. Doesn't matter how much I love a trade, they don't love you back sometimes. So stop right there. Now, a little bit. I give it a little room under the trend line. Then you have price support here at about 65, a reaction low there, so somewhere in there again. And it's SMG. UAN, this one put in this divergent low right here back in March. Breakout, started to run, but then it realized the sector wasn't running with it. And so this is why you've heard me say something I've learned years ago in my analysis. If I'm trading any stocks in a sector, especially if there's high correlation among the components, which there often is, I want to see the sector looking good, because a breakout in one will most likely only go so far without its buddies. It's like a flock of birds. You see one start to leave the flock, and the flock goes the other way. You see that bird, he goes back to the flock for safety. It's just his instinct. And so that's the same thing here. So bullish chart and broke out, and it's not like it didn't run. It ran about 18%, but then the sector said, hey, no, guys, we're not ready to run yet. UAN, come on back. UAN, by the way, is called CVR Partners. But now it's set up this other downtrend line right here. And that's it. So basically it's a breakout. It remains above the primary downtrend line right there. That's the primary downtrend line. And let's see, I could probably play. No, that's still it. It's still above it. And a little bit of price support. I'm talking to myself here, guys. I'm just lining up some levels here. There's a reaction low. Yeah, that's it. Let's set an alert. If it breaks that trend line, that's your objective buy point right there. Targets, even though we had a reaction high there, this is where that was a target I had from back here, which was hit at 86.30. Probably still comes into play. We'll see. You can also see when it ran into that, when it had that high, it had negative divergence too, and so it got ahead of itself a little bit. Again, it was about a 42% run off the low. Let's just look at the other targets. We already hit that one, so let's just say that one has a better chance of getting taken out. My next target was and still is 93.80. So if you want right now, initial target, that's going to be a 34% run, and that was the other target I had, and that's about 50%. You can see I created that back in May. And so there's a common theme here. A lot of these stocks, to me, look like they're poised to run about 50% if you're trying to get an idea of where we might go if this sector holds up. BIOX, you can see here's big support, and sometimes you break support and that's it, and that's what stops are for. So when you break support, you don't break support just thinking that it's going to regain it. What the play is, when you recognize a support break, you can have your stops if you bought it at support. I probably would have highlighted this one too back in those videos. I would have highlighted that as support. I labeled that back on July 5th. And so your stop would have been somewhere below support. And the only play, if it breaks support, if you're either still in it or if you're looking to buy it, is a recovery back above, because then it becomes a bear trap or a false breakout. This one never did, and it's been heading down. Must have something wrong with it if the rest of the sector's been moving up lately. And I can't make a case to buy it. My guess, it's going to reverse here, and it's probably going to run harder than most and probably outperform, because if they start buying it, only because institutions will pick up on what I'm seeing, and if the sector continues to firm up and those breakouts that haven't yet occurred, let me say that's very important. A lot of these have broken out and a lot haven't. So the ones that, if they do break out and they continue to run or start to really run, then you might see the bottom pickers come in here and buy this one. But again, I can't make a case to buy it. There's nothing in the charts other than a pending bullish crossover on the PPO. Oh yeah, positive divergence on the 60. So you can make a case there. But again, keep your position size a little smaller on this one. There's a bullish falling wedge breakout, and let me give you a sold target here. I might even play with this one, a little bit of play money here. It'd be about a 25% run up to that and almost $10 level right there. And actually, I should be correct. There's a bottom of the gap right there, 967 T1 first target, 21%. If the top of the gap, if the full gap is backfilled, 25, 26% for you. All right, next up, LRVO. I don't like it. Nothing I see in there that makes me want to buy that one, so we're going to skip. IPI, Intrepid Potash. Another one, I believe I've got this one too. It's all long-term accounts. They're not my trading accounts. I don't actively trade. Almost could, yeah, you can draw that there. You've got a potential symmetrical triangle pattern right there, close to it. And more importantly, we're coming off a big divergent low. Most importantly, let me back up. The grains are rallying. Okay, that's the most important, and they look good. And they're not at my final targets; they're at my early targets. So that's first and foremost when I'm doing this. Second is obviously their own charts, but this one you can see back here. Maybe you can't because it's buried. It says resistance zone. So I've had that here for a long time. Make it a little bigger. And so I initially made that back in July 2023, and it was a resistance zone back then, 2023, somewhere here. And so if I thought it was back then, the fact that we hit the top of it and reversed in the middle again further validates my resistance zone, which again was laid out back here because you could see it was good resistance all the way back before. Okay, what does that all mean? Well, it means the more obvious or strong a resistance level is, the more likely the stock is to run when it breaks it out. As you can see in the top of my resistance zone, I have it at about 27.92. You can call that round up to 28 to be safe. Break above 28, it should run. Targets are 33.90. I'll give you a 22.5% and 40. I can give you another one in there. Yeah, we'll do that for now. But you could see before I had $48, and that's going to be about 70% if hit, right? And then potential up there. So, and remember, the bigger picture is you had a downtrend line, breakout, powerful move, went right up to the resistance zone that I was highlighting before, and that's where I would have expected it to stop, and did expect it to stop. Hit it again, and so just needs to punch through there. It's going to be a powerful breakout if that happens. So a couple more and we'll wrap this up. AVD, American Vanguard Group, not much about them. Looked like it had potential to run out a little, you can see here, this was big support back here. Something happened that was big support, broke it. It was very bearish. The bottom fell out of the stock, rallied back up, got smacked down hard, a rejection on the broken support, which becomes resistance. Then you had a nice clean uptrend line here. You broke that. This thing's just been stepping down in waterfall fashion. So there's something going on with this company. I don't know the fundamentals on it. I don't care. I trade the charts. It's $5 stock. Market cap's $148 million. So it's definitely risk in this stock. But again, if they come in and start buying the sector, one thing about it, and I haven't checked this, but I'm going to guess it probably has high short interest. And so even if this company is going to be bankrupt sooner or later, if this sector continues to get some traction, or if, just technically, if it can break out here, it should run. You're probably going to get a short squeeze that can take it up to here. But again, I have to throw out there that companies like this, I don't know what's going on, why it keeps waterfalling down, stair-stepping down like that. But Chapter 11 bankruptcy filing may be in the cards for this one. And the thing about those guys, they don't tell you when they're coming. So you could be holding the stock, it'd be rocking and rolling for you, and then one day, boom, it just drops 70% at the open. You're saying, what's going on? Why is my account down, or this position? So, get Vegas money. That's the key to that. Don't put in anything more than you're willing to lose. But the upside potential, if it breaks that trend line, we get a short squeeze, 55%. I think it would blow right through that previous reaction high, backfill the gap. And so, again, this is a gunslinger trade, but worth mentioning. And there's a downtrend line above it. And there's also one more. Let me give you one more price level here, 962, which that's my max target right there. So that one, you're looking at about a 90% gain from where we're at now. Almost 90, up to 962 in the intersecting downtrend line. BHL, this one must have split. That's why this line's moved. This charting program, which drives me crazy, does not adjust for splits. You got to do it yourself. Either way, we're getting down to, this is a $43 million company. So, some of these garbage companies will run, the sector runs, but you got to be careful. So I already covered the big names. Oh, here's China Green. This one I would have given you this trade idea back in 2020 when I was bullish on the sector. Looks like I gave you a max target up here of 1435. Guessing our buy point. I don't know if we bought it here off that divergent low or the breakout of that downtrend line. But either way, so that was good for 570 or 500+%, right up to my max target. It's the nature of this little small cap stock, micro cap. This is a $34.8 million market cap. Very risky. But when you look at it this way, so coming off the divergent low, this chart looks similar to the last time I gave you that trade back then. You had positive, you put in a divergent low, it had an initial pop, just like this. It had an initial pop right there, right? Then you put in even bigger divergent low, like you did right here. And this time around, you're testing a primary downtrend line. Oh, like you were right here, right? That one had a few fits and starts. They were all intraday pops, no solid close. Those are intraday, skinny part, the candlestick shadows. Finally broke out here. And there it is. So there's your trend line. You set a price alert. If it pops that trend line, you have first, you can call it first target. I'm going to call it the BOD, or first resistance level, benefit of the doubt level, be a 16% run. It's 309, probably get a little reaction there, but this is a potentially explosive setup. It could be a blast right on through there, not pass go, not collect 200, go not to jail, but I could go to jail. It's a cheap little, low price stock, very small market cap, thin float. But those little thin ones like this, especially if you have a lot of shorts, doesn't take many shorts in there. A short squeeze in this stock, again, we're at the same level. So if you want to know what's the potential, we're at the same price point, or reverse off the same level it did back then. It has an identical technical posture. The grains are rallying, just starting to rally now like they did back then. So who's to say this thing can't run, duplicate that and run again? So if you want to know where it can go, this is a really nice target right here. If it gets up there, 775, if you're looking for something a little lower, 200% run. And so let's just say that's your target, 200%. You take you could do if you did a 40% stop loss, which is too much, I don't think you need to, you're giving yourself and that's would be just back down to the recent lows, you're giving yourself a 5-to-1 RR, if you're targeting a 200% return. So you could do that. If you give yourself a 10% stop loss, again, if it breaks out, then you have a 10-to-1 RR, again, if you're targeting 775. Alrighty, a few more. We'll wrap it up. Seed, ready to pop right above that downtrend line right there. Already coming off a divergent low. Breakout. And again, the nature of these stocks, these lower price ones, it's the rallies are, I've traded them for years. They're gold mines to trade. These are all charts. You can go back and see trades in the past. But they're gunslinger trades when I get down to this. This is a $19.3 million company. Like I said, there's probably some of you listen to my voice who could buy this entire company, all the shares. If you get $19.3 million, if you're doing well. But there's a breakout above that trend line. Would take us, I might have to tweak. These are, updated this. I'm going to pull that down there and tell you right there. First target, 456. That's going to be about a 35% run. Second target, I'm going to light up this line as I've had here before. It's going to come into play again if we break out. About 6, a little over 6. And then ultimately, you can see there's a lot of resistance here. This was a resistance zone. So let's just say this is our current max target zone right now. Everything's subject to change. And these guys could just crap out, these little guys too, and then it just goes away. But there you go. So there's your targets on that one. YTN split, so reverse splits. Messy, sloppy chart. I can't even make heads or tails of this now. It's only a $1.4 million company. So, oh, it stopped trading. There it is. So, see, there's the risk in these little low. What they do is these shenanigans. These companies, they face delisting if they trade under $1 for too long. So then they'll try these shenanigans to get it up there, reverse splits and all that. But eventually, like I said, this one yield 10 biosigns. When you see this, that's either a delisting or bankruptcy filing. Just stop trading at that point once it dropped down. So I think it went to the pink sheets, if I'm not mistaken. All right, guys, that's it. That's the lowest price market cap, and this one's still in play. 26. This is a penny stock. NITO, N2 off Inc. Again, get down there. Where's target on this one? Trend line. Keeps running that downtrend line. That'd be about 100% rally if hit. Do your own due diligence. Some volume coming into it recently, but that's it. Let me wrap the video up here right at the 45-minute mark. So that is covered a total of 17 individual ag input stocks there, with most of those looking good. And again, I can't impress the importance of position size management or just sidestep those little low price guys. Pretty much everything in the sector is pretty volatile, but I started the video out with the bigger ones, and those are a little more, quote unquote, a little more secure. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.